Things are looking pretty dicey in the stock market. It just has such an ominous feeling. And the news that just hit the wires is this: Trump says tariffs on Canada and Mexico will go forward. It's not really look, it's not a good thing for the stock market. And I think a lot of people are investing with the intention of saying, just a little more upside, or just these big tech stocks, artificial intelligence. It's a can't miss situation. But now Microsoft is saying they're thinking about scaling back some of their AI expansion plans in terms of what they're going to do for servers and server farms, things like that. And it's just the news all over the place is starting to look like maybe there's, if not too much capacity in artificial intelligence, it definitely is looking like the companies that are spending the hundreds of billions of dollars, the big seven top tech companies, it looks like they're starting to telegraph, or at least I'm interpreting it this way, that that they want to let their current investments start to bear some fruit before they start investing even more money into AI capabilities and expansion. And that's just not a good thing for a market that is built up on a lot of AI expectations, and for a market that is very, in my opinion, very highly or very richly valued. So let's just run a quick intro and we're going to have a good show. And I just want to talk about some things to look out for and the way I've seen past uh, bear markets play out, especially in technology. I want to give you some signs to look out for and some things not to do. Okay, we talk about what not to do here even more than we talk about to do. So let's roll the intro and stick around, and we'll get through this in as quickly as I can. All right, couple of minutes. Here we go. All right. Thank you for joining me. That black skip you just saw on the screen, just 'cause for some reason, camera number two, um, it's just not working for me today. That happens. But the big news, which I want to pop on the screen here, is look at this. Trump says tariffs on Canada and Mexico will go forward. This is just the latest salvo in news that is pushing stocks all over the place. It's Monday while I leave this, but this episode is going to be have some timeless nuggets. So don't worry about so much what the day is. The reason I bring up the day is because last week we saw, last Friday, the stock market's worst day of the year so far. And I know 2025 is pretty new, but no matter how you slice it, last week was a tough week. Thursday was a tough day. Friday was a tougher day. Now, when I say tough day, we're not market strategists. We're not hedge fund managers, you and I. We're long-term investors. So if you think about it this way, what happens in the market today is really not what's going to impact you 10 or 20 years from now. We'll forget about this. We'll have other problems to think about and to worry about. One day someone might say, remember those olden days when we had a president that was using tariffs? He kept saying tariffs were his favorite word, and how bad that was for the stock market and economy. Well, that's what I think. That's what I think at most is what this is going to be. Now, though, while we're going through it, I think it's going to be ugly. So it's so many things to unwrap. So, I mean, the hot news is tariffs. So let's talk about that. If there's, let's say, 10 or 20% tariffs, I'm not sure exactly what the tariffs are going to be on Mexico and Canada, but it's going to hit us pretty hard. That means price of oil goes up, cost of gasoline goes up because we have a lot of oil from Canada. All right. Auto parts, automobiles, because we have tons of automobiles and auto parts going between Mexico and the U.S., Canada and the U.S. And, you know, these two countries combined are by far our biggest trading partner. In fact, Mexico is our biggest trading partner, bigger than China. So this is a pretty big deal. Now, tariffs means that U.S. importers have to pay more money on imported goods. And that cost gets passed on to you. It's basically everyone's paying a penalty for buying uh, foreign sourced goods. Now, some people will say that's good, some people will say that's bad, but I think a lot of people, you're going to really have to wait and see how it affects you personally. If you see the price of everything you buy every day go up a lot, uh, it's going to become miserable. It's recessionary, and all of a sudden, the talk of recession, all of a sudden, talk of recession is very squarely on the table. And we had warnings from Walmart of a coming things are slowing down. That's a major to me. Walmart is such a really good proxy for the economy. And Walmart also talks about how people of greater means are trading down to Walmart stores from higher end stores. And now Walmart is the biggest grocer in the country, and now people are shopping more and more at Walmart. It's just it's a sign that things are slowing down. Record number of people are maxed out on credit cards today. So stock market's looking ominous, but what's really been holding it up have been the Magnificent Seven artificial intelligence related stocks, lots of tech stocks. But it gets to a point where, if growth, for example, at a company is 100%, the company's growing annually at 100% earnings and revenues. I'm using this as a general example, okay? Uh, and the stock goes up a lot, and all of a sudden it's trading at, let's say, 100 times earnings, meaning investors are willing to pay $100 today for $1 of earnings in the future. And a lot of stocks are 100 times earnings. The overall S&P 500 is like 25 times earnings, which in the longer term scheme of things is considered high. That's definitely the high range of valuations. I got an itch in my eye. Oh my God. All right. So let's square this circle. I'm trying to really, I have so many things going on in my mind. I want to explain them all to you. But let's just say that instead of growing at 100% of the companies, let's say now 130 times earnings, because you're paying for attractive growth. You're paying for, let's say, an artificial intelligence company that makes semiconductor chips, and everybody needs those chips. And companies are spending hundreds of billions of dollars on those chips, but the company that makes the chips is worth, let's say, over $3 trillion. Folks, I don't care what you tell me, trillion-dollar valuations is not the new normal, in my opinion. It is just very few companies get to call themselves a trillion-dollar company, let alone 3 trillion plus. But now let's say that company is growing 100% a year, is all of a sudden growing at 40% a year. Still excellent. And there's going to be some analyst somewhere on TV, probably more than one, who's going to say, but that's really good. There's no other place to go for these chips, and 40% growth is really good. But we're talking about stock prices, stock valuations, not if business is good or not. There's two different separate, you have to separate those two. Well, business is still really good, so hold on to the stock. No, you have to look at it in two different ways. Business could be really, really great, but you have to look at the valuation. And if a company's trading like it's going to earn 100% a year or grow 100% a year in earnings and revenues for the next couple of years, and all of a sudden their growth slows down to, let's say, 40 or 50%, while still amazing growth, maybe 130 times earnings is too much, and maybe the stock should be marked down to 75 or 60 times earnings. If that were to happen, you're talking about a 40% drop in the price of the stock. So it's not so much business is good. The spending for artificial intelligence, we all expect it to continue to do well. But doing well is not enough. It's got to get even better and better and better and better. And it's been getting better and better, which is why investors are so comfortable with mega cap stocks and high valuations. But when that growth slows to even a slower rate, still a great rate of growth, but but not as good of a great rate of growth, That's what pushes stocks down. And you combine that with tariffs, which are going to make everything more expensive. And that means the Federal Reserve is in such a bind because now they can't cut rates. The Fed can't cut rates if the economy is slowing and if unemployment starts to go up, and you're seeing all the mass layoffs in government positions. That will start to spread to the private sector. Yes, I know government jobs that are cut, many of these people should be absorbed into the private sector, out of the government sector to the private sector, but not all. And maybe private companies don't need all these people and they can't hire them all at once, or they can't hire everybody from Washington, D.C. Not everybody in Washington, D.C., or there in that area, capital district, is, not everybody's ready to just pick up and move to different parts of the country. But there's layoffs happening here where I live on Long Island. There's layoffs in Alaska. There's layoffs in California. There's layoffs in every state, Texas as well. So it's not just like a red state or a blue state thing. These layoffs spread because now people have trouble paying for their mortgages, paying for their cars. There's people who are spending less money at local businesses. So now the local businesses start to suffer. Is that in and of itself enough to cause a recession? From what I'm reading, most strategic economists say no, that's not enough to cause a recession. Is it enough to cause some local recessions in local areas? Yes. Is it enough to get the economy to slow down a little bit to hurt stocks that are dependent on how the economy does, like consumer electronics and consumer discretionary, consumer tech, and technology? The answer again is yes. Is a little bit of a slowdown, if the little enthusiasm comes off of artificial intelligence spending, is that enough to bring the stock market down? Yes. And tariffs, and the Fed can't move again because if prices are high because of tariffs, the Fed's not going to separate high prices from inflation versus high prices from tariffs. The Fed just sees high prices. And now they are handcuffed. The Fed can't cut rates because of tariffs. So now you have higher prices and a slowing economy, and it's called stagflation. What do? Layoffs start to spread it from the private sector. The stock market starts to go down. The housing market is, I'm going to use a big word here, moribund, meaning it's a buyer's market again, but only for buyers that can pay exorbitant prices for homes today. You add it all, and it looks to me like I'm pretty bearish right now. Now, most of my clients are invested for the long term. Even my clients who are in their 70s are still investing because they're still planning on living another 10, 15, maybe 20 years. So it's not like they don't have to worry about inflation anymore. Many of them have enough money that even if the market goes down, they're going to be okay. In fact, all my clients in the market over 75, they only have money committed to the market that's not going to really impact their ability to live their lifestyle in retirement. But it's still going to hurt. It's still going to scare people. Even wealthy people in the country clubs and all over Florida, they might go to the club less. They might go out to dinner less. People get scared. And then people see the valuations of their stocks go down. And by the way, if some of these Mag 7 stocks went down, I'm talking the Metas, which is Facebook, Nvidia, the names, Microsoft. If these stocks all drop by 30%, you would still have nothing to complain about because they're up so much in the last 5-10 years. But people don't remember that I started with $10,000. Now it's worth $1 million. They only remember the million that went down to 700,000 as an example. It doesn't mean that everyone with $1 million is going to see their account go down to 700,000. It does not mean that everybody started with $10,000 is going to go up to $1 million. I'm really using very general, broad terminology here to make my points. One of the problems with the down market is you have continued bullishness in the stocks that are leading the market down, where analysts will come out and say, stocks marked down 20%. They still have great growth. They're the only ones who can do this, the only ones who could do that. They've got a moat around the business, meaning that no one else could get into the business or it's too hard to get into that business. So we think now it's a buy. And you get into this, what I call catching the bottom, where you keep trying to catch the bottom. I'm not saying it's bad to buy a cheap stock, but I'm saying every situation is similar, but there are differences. And I see some differences between now and, let's say, a couple of years ago. It took a lot to get me, it takes a lot to change me. I don't get overly bullish or overly bearish. I'm pretty even, and I'm pretty much going by the fact that I'm looking at a client's time horizon, and that determines how much risk they could take. But I also know that people can only take so much pain, and I always like to ask, what good is an investment portfolio if you can't stick with it? Because ultimately, it's not about going for a portfolio that could go up the most. It's about going with a portfolio of investments that you could ride, that you could live with through the ups and downs of the market. Now, we've been scaling back the big winners in industrials, in pharma, not just in technology. It's what we do. And when we find that we don't have great places to go, we buy T-bills. We don't buy T-bills forever. T-bills by their very nature are maturing in under a year. You could call 2-year treasury bonds T-bills too, but short-term stuff that gives you an opportunity to at least make 4% on your money in something stable and it'll mature at par while you wait. If you put $100,000 into a 6-month T-bill at maturity, you're getting $100,000 back, which, by the way, does not always happen with a bond fund. There are bond funds that people bought 4 or 5 years ago. Unless interest rates are going back down to zero, I don't ever see those funds going back up to where they were. And so all of you who are sitting on big losses on bond funds, ETFs that you thought were so great, think again. Maybe you'll catch up one day from years and years and years and years of reinvesting, and it'll look like you get back to even. But really, it's just that you're relying on, very little interest to get back to even. And you have to wonder, is it worth waiting, or you're better off in something else? That's a story for another day. And if that's your situation, you can give me a call. We'll talk about it. So the problem with the beginning of a bear market and a market correction, and even just like a bad month or a bad week, is that they all look the same. It starts with stocks going down. There are analysts who are negative, so they start getting trotted out in the media and TV, and the "I told you so" crowd comes out. This is not about "I told you so." This is about if you're a certain age with a certain risk tolerance and a certain time horizon to when you need the money, you need to adjust accordingly. So my message really is, for those of you who are invested, in particular the 60-plus crowd, you're the ones who get into the most trouble when the market goes down. If you weren't properly allocated and if you didn't rebalance. So when your allocation to stocks went way up because the stock market went way up, and you're loving to see these gains, and you're starting to spend these gains where you're spending other monies you have holding onto the stock market because you're making money there. So why would you touch it? This is really for you. You're the one who needs to start to back off. It's not too late. Don't worry if you missed the high. One day last week, I think it was Wednesday last week, the S&P 500 hit a record high. So how could you be negative? Well, roughly like 5% of S&P 500 stocks hit a 52-week high when the S&P went up. That is a very small number of stocks hitting a high. Most stocks are deteriorating pretty quickly. You saw small cap stocks in the last couple of months get crushed. I mean, the small cap averages, the small cap ETFs, they're basically flat over the last 12 months. So that whole Trump bump is gone for them. And I'm seeing this with other sectors as well. Mid caps are not doing so hot. Tech stocks have really backed up a lot. Tesla certainly has gotten crushed. Meta, which was 730 or so, and now it's like 660. It's a pretty big drop in about a week and a half. So what I'm seeing is a confluence of events, and people are starting to say, I'm not doing anything now. And I think businesses, I know businesses are starting to do that too. I want to see what the tariffs are going to do. And if we do get tariffs, American companies, A, will have less competition. Do you think that they're not going to raise their prices? Of course they're going to raise their prices. Well, if a car made in Canada costs $40,000, or let's I don't want to pick on Canadians, they're our friends, but let's say an imported car costs $40,000, and the same American car costs $40,000, and now because of tariffs, that car costs the foreign imported car costs $44,000. The imported car is now $44,000, up 10%. The American auto manufacturers, they're going to raise their price too. Maybe they won't raise it to 44, but they'll raise it like 43,000. So they'll still be competitive. But this is an opportunity for them to make more money too. I'm all for profits, but tariffs have consequences, and they're big consequences. And it's not so simple as just throw on tariffs. Now, maybe the news or by the end of this week will be, okay, we're not going to do the tariffs. But this is creating so much volatility in the stock market that it's making it almost impossible to plan, because, if you're 65 or over, you look at all your money in the stock market and you count it. You add up all the money. You add up all your accounts and say, this is my worth in the market. And if it's down 10% or up 10% back and forth, you basically just freeze and you don't know what to do. Volatility is worse than a flat market. All right. Even a gentle glide path toward a lower market is something that people could live with, but it's extreme volatility, extreme ups and downs over the near term that shakes the confidence of retirees and gets them to spend less money. And since we are an older nation with wealth concentrated in the hands of boomers, it's going to have, aftershocks, reverberations. Is that the right word? Reverberations throughout the economy, right? So that's what's happening. We have a viewer here. Hi, Dad. I'm so proud of you. I love you. Oh, I'm so proud of you too, Jess. I love you too. Okay, thank you. So that's the story for today, and I want you all to realize it's time to rebalance. Don't say I'm not going to sell a stock because it was 750 last week and now it's 650 this week, and you have the stock at 200. You really need to take a close look, because we have a true bear market and the air comes out of the tire, especially and I've seen in technology. People keep saying, people saying now is the bottom. Now is the bottom. And I saw this in the year 2000. The bottom was endless. It was over and over and over, new bottoms. You get like a good week in the market. Everybody say, oh, this is great. Now we're back to the races. It doesn't happen. And by the way, the internet became bigger and better than anybody could have imagined in the year 2000. But the stocks still got crushed. When I say the stocks, I mean every single one of them. It didn't matter if you were in the best ones. Microsoft, every one of them, they got absolutely crushed. The S&P 500 went down over 50%. And people were so a lot of people just sold out of the market, never went back in. They live another 20 years and now they can't eat anything. They can't afford anything because they weren't in the market. They didn't ride it back up, and inflation got the better of them. So that's my piece. This is a little bit longer than I expected, but I hope you're being more cautious than aggressive. For many of you, especially when your time horizon for life is like 20 years or less, you're not a kid anymore. You're not 30 years old anymore. That's for you. I talk a lot about investing for the younger set, but I have clients of all ages. All right, that's about it. I appreciate that. By the way, Blake is out there. Blake, thank you very much. All right, guys, I'll be back tomorrow, and keep on keeping on. Thanks.